Welcome to today's What Will Move the Market show. I'm your host Prem. It's Thursday, January 22nd, 2026, and here is everything you need to know as the markets open for today. Overnight on Wall Street, the mood was firmly risk-on. The Dow Jones Industrial Average jumped about 1.2%, adding nearly 589 points to close around 49,077, while the S&P 500 gained roughly 1.2% to finish near 6,876. The Nasdaq 100 outperformed, with a rise of about 1.4%, ending close to 25,327, as large-cap tech saw broad buying. The big catalyst was President Trump's latest reassurances on trade and global tensions, which calmed worries around new tariffs and helped investors rotate back into equities. Value and cyclical sectors such as industrials, financials, and energy led the move higher, while growth and tech comfortably participated but did not look frothy. Among individual names, metals and mining stocks benefited from the rebound in risk appetite and firmer commodity prices, while select airline and travel names continued to gain on the back of resilient demand commentary. On the other side, a few high-beta tech and smaller regional financials saw profit-taking after recent sharp rallies, keeping a lid on the overall advance. For Indian investors, the overnight ADR performance offers a clean data-driven cue set. Infosys ADRs closed at about $18.31, up roughly 0.55%, signaling sustained overseas appetite for large-cap Indian IT services. HDFC Bank's ADR ended near $32.13, lower by about 0.65%, reflecting continued caution around private sector banks, even in a risk-on global session. ICICI Bank's ADR settled around $29.30, down close to 0.68%, again hinting at some residual nervousness around Indian financials. Reliance's GDR finished near $61, gaining around 0.49%, helped by steady refining and petrochemical margins and stable energy prices. Taken together, these cues point to relative strength in IT and energy, with banks likely to open on a more subdued two-way note. Turning to Asia, the latest available closing data show the region leaning mildly positive. Japan's Nikkei 225 last finished near 53,362, up about 0.24% in its previous session, as exporters and tech names in Tokyo tracked the Nasdaq 100 higher. Hong Kong's Hang Seng Cash Index closed close to 26,663, higher by a marginal 0.02%, suggesting that investors are still cautious on China-linked names, even as global risk sentiment improves. The Shanghai Composite Total Return Index ended around 4,719, up about 0.08%, helped by pockets of buying in financials and state-linked blue chips. These are prior session closes, and any live moves through the Asian morning will reflect fresh headlines around US policy and regional data as the day progresses. For the direct lead into our own open, Gift Nifty futures are quoting near 25,299, up about 0.54% from the previous close. That indicates a mild gap up in an attempt by the Nifty to build on yesterday's late session recovery, rather than a runaway short squeeze. In simple terms, global cues are constructive, but domestic traders will still want confirmation from early market breadth and bank stocks before chasing higher levels. On the global news and geopolitics front, the key driver remains the tone from Washington and other global capitals. Recent messaging from President Trump has leaned more conciliatory on contentious issues such as tariffs and resource-linked disputes, which has taken some immediate tail risk off the table and supported equities. At the same time, markets remain alert to any sudden change in stance on new flashpoints, whether in Europe, the Middle East, or other strategic regions. Central bank expectations are also in focus, with investors betting on gradual rate cuts later this year, but recognizing that incoming inflation and growth data can still shift that path. That push and pull between geopolitics and policy keeps a floor under safe haven assets, even as equities rally. Back home, Indian equities come into today's session after a choppy range-bound day, where bears failed to press their advantage. The Nifty 50 recently closed not far from the 25,100 zone, after briefly dipping below 25,000, and then staging a late recovery, signaling that buyers are starting to defend that big round number. Bank Nifty has been the weaker link, closing in the high 58,000s, as private banks face sustained selling pressure, while the Sensex mirrors Nifty's corrective, but not yet broken structure. Market breadth has been soft and volatility indicators have picked up from ultra-low levels, reminding traders that the easy trend-following phase is behind us for now. On flows, foreign institutional investors have stayed net sellers in recent sessions, whereas domestic institutions continue to absorb supply with healthy net buying. That dynamic is preventing a deeper slide but also means rallies can be sold into until FITs turn more constructive. On the macro side, the Reserve Bank of India's latest communications have remained optimistic about India's growth momentum, highlighting resilient domestic demand and a relatively favorable inflation trajectory. That positive macro backdrop, even as global growth wobbles, acts as a medium-term anchor for Indian assets despite near-term currency and equity volatility. Let's talk technicals. With GIFT Nifty pointing higher, the Nifty 50's immediate support band for today sits around 24,900 to 25,000. As long as the index holds above this zone on a closing basis, the current phase can be treated as a corrective consolidation rather than a full trend reversal. On the upside, the first resistance cluster lies in the 25,300 to 25,500 region, where recent rallies have stalled and where a lot of call writing is visible. A sustained push above that pocket could trigger short covering and open the door to the mid-25,600s and beyond over the next few sessions. Bank Nifty's intraday map is slightly more fragile. Immediate support is placed around 58,500, with a deeper cushion closer to 58,000. Below these levels, selling pressure could accelerate, particularly if global financials also start to roll over. On the upside, resistance is expected in the 59,000 to 59,500 band, a zone that has repeatedly capped bounces in recent days. Traders should expect more whipsaws in banks compared to the broader market and calibrate position size accordingly. In commodities, the overnight moves were moderate but still very relevant for equities. Gold, tracked via dollar-denominated contracts, is trading near $4,787 per ounce, down about 0.94% on the day, indicating a small bout of profit-taking after a strong earlier run. Silver, quoted around $91.41 per ounce, fell about 1.82%, showing that the recent explosive uptrend in the metal is pausing for breath. WTI crude oil futures are near $60.58 a barrel, down roughly 0.13%, a level that remains manageable for India in terms of imported inflation and margins for oil marketing and aviation companies. Natural gas contracts are around $3.47 per unit, down about 1.28%, which slightly eases global input cost pressures for energy-intensive industries. Putting this all together, the day plan is straightforward. This is a market where global cues are supportive, but the Nifty and Bank Nifty are still sitting right on important support zones and FIIs remain cautious. For traders, the focus should be on disciplined risk management rather than aggressive bets. Keep position sizes moderate, respect stop losses around the 25,000 area on the Nifty and the 58,500 zone on Bank Nifty, and avoid over-leveraging in options, especially under the tighter F&O framework now in force. Look for sectors that align with the overnight cues, IT and metals on the positive side, and selectively approach financials where global and ADR signals have been more mixed. For investors with a longer horizon, use volatility as an opportunity to gradually add quality names instead of reacting to every intraday swing. That's it for this morning's What Will Move the Market show. Stay tuned for the evening wrap, where we'll decode how these levels actually played out. Send in your questions and thoughts so we can feature them on upcoming episodes. And don't forget to subscribe to this podcast so you can join us every trading day right at 8 a.m.